Hey everyone, thank you for joining us today. We're going to have a great webinar with Charlene from Nationwide. As you have questions, feel free to type them in the question box on your control panel at the bottom on the right side of your screen. We'll answer them at the end of the presentation. Also after the webinar, feel free to give me a call to receive a copy of today's webinar and answer any additional questions you have. But thanks again everyone for joining us today. Charlene, go ahead and take it away.
Awesome. Thank you so much, Alex. I appreciate it. And thanks for everybody being here today. Appreciate that. So we're going to talk a little bit about indexed universal life this morning. Before we start, I'm actually not going to read Alex's slide, but I have a question if you guys want to pop it in the chat box to see who gets the closest. And we've got a wireless keyboard for anybody that wants to take a minute to answer that. But I'm going to ask you, when was IUL first introduced to the marketplace? I'll give you a second. When did IUL first come to the market? Seen any answers there, Alex?
I've got one, 1994.
All right, anybody else?
Give it a minute here, see if anyone else has some guesses. And that chat box is in the right-hand side of the toolbar that you'll see.
All right, well, if we don't have any other takers, we can go forward unless you have another one in there, Alex?
Nope, go ahead.
All right. Well, good guess on 1994. Pretty darn close. 1997. So we'll get you that wireless keyboard for being brave enough to chat your answer there. So thank you for that. Amazing, really, to believe that IUL has been out in the market for 26 years. And we've had a lot of success and a lot of changes and innovation in this industry. But why did we come out with IUL? Why did carriers bring this to market? If you look back when I grew up in the business in the late 80s and early 90s, it was all about variable life. That was the hype. And we were showing 12 and 14, some even 16% interest rates on life insurance illustrations. They were going to be funded at $10, $25, $50,000 a year. So it was this great boom in that variable life marketplace. And then, as we all know, what happened in the late 90s, early 2000s, the market wasn't that great, and people got really nervous. So they gravitated then to universal life, just traditional universal life, a carrier interest rate, a fixed bucket, and that's where we saw a lot of the sales. And then we ended up with no lapse guarantees. Again, those became more like a permanent term contract. We still sell those today. I'm still a fan of them, but no cash value, but a permanent policy that I could direct to age 120, age 90, what have you. But IUL then, that came about because of that, the kind of the influx I mentioned with the variable marketplace in the late 80s, early 90s. And the clients were looking for a solution where they wanted a little bit more safety than that market provided. And they also wanted the guarantees that came with a traditional universal life policy. So the safety, the guarantees, and then, oh, by the way, they still did like the opportunity to have a little bit of cash value crediting. So they kind of wanted their cake to eat it too, right? I want the guarantees, I want the cash, but I don't want to lose everything in the market. So IUL came to the market with those answers, and the coverage it provides gives us an opportunity for that upside potential that these clients want, usually greater than what they would have seen in a traditional universal life type contract. And the client then ended up with more control. So they didn't have to give it all up and pick their sub accounts in the variable life and hope for the best and manage that policy like they would their own investment options. But they could look at an index type contract and have a little bit more flexibility. So what we see then in these index contracts is it is a universal life policy. It's not regulated like variable life, of course. I think everybody knows that. But it's a universal life chassis where the clients get those options. So they can direct the premiums into different indexed accounts. And there are many of those to choose from today. The most common, I would tell you, just likely because most people understand it, is the S&P 500. So that you will typically see in most of your IUL policies as one index option that your clients can pick from. The other difference in IULs is that we're going to look at the floor and a cap and a participation rate. So what do I mean by the floor? Well, if I'm in a variable life contract and the market goes up 32%, I'm so excited, that's great. I get to participate in all 32% of it because I'm in a VUL. Same market turns around and goes down 32%. Oh, bad for me. I'm participating in that negative 32% return. With the index contracts, I have a floor. So I am going to participate in only the upside. If that market goes down 10%, 20%, 30%, my floor is 0 with most carriers. That's a pretty typical guarantee in the indexed world. So I don't have to worry about the negative returns. I do get to participate in the positive returns. And again, those participation rates will vary by carrier. Oftentimes we see them at 100%. So that just means if the market does 10%, I'm participating in 100% of that 10%. So Nationwide has their S&P contract has currently a 9.5% cap with a 100% participation rate. So in my example, if the market returned 10%, even though I get 100% of that 10, I'm capped at 9.5. So it's structured to the caps and the par rates. But again, I don't have to worry about that downside, which is where most people were looking when the Index Universal Life came about. They wanted, again, that potential upside. I'm okay with taking 8 or 9 or 9.5%. I just don't want to lose 8, 9, 10, 20%. So we look at the crediting, and again, you pick the index and then it's credited based on your certain whatever index you choose. So again, I mentioned Nationwide's S&P is at 9.5%. We have a multi-index that's got a cap of 11.5%. So there's various different places that I can choose inside each individual carrier to put that money. I don't have to pick one S&P. I don't have to put 100% in, say, an S&P account. I can vary that. And you'll see many carriers and they have gone to volatility controlled indexes, so a little bit more managed on a monthly basis to kind of help spread that risk out. So there's, when you look at an index option, you'll see a lot of choices. But that, again, gives that client the ability to kind of manage their own future with their policies. They get to pick where it goes, but they're not subject to the ups and the downs of a variable marketplace. Traditional universal life interest is fixed, so we're usually going to see a much better return in an IUL. Of course, we can't guarantee that, right? But it's usually, you're going to have better participation in those indexes than you would a traditional company that's just sitting in the carrier's fixed account. Nationwide, for example, in our fixed account is crediting 2.5%. So most people feel they can do it just slightly better than that in today's environment. So we'll talk about the indexes and the strategies and then the different segments that you'll see out there. When I mentioned the S&P 500, that would be a single reference index, right? It's just, I want to put 100% of my money in the S&P 500. That's completely fine. There is nothing wrong with that. But then know that there are multiple indexes in the various carriers. As I mentioned, we have the S&P, we've got the multi, we've got a couple different strategies that have uncapped account options. So there's a lot of different places that you can diversify, mix and match to your heart's desire. The strategies then are going to be point to point and monthly average. So point to point means, January 1, 2023 to January 1, 2024. What was it on January 1st of 23? What was it on 24? And when I look at the 24 number, that's going to be, if there was an uptick in the market, that's going to be the index that I'm going to get credited. Typically, we see a lot of people kind of default because they're comfortable with point to point. It's mostly utilized in an up market because I think the market's going to get better. I want to make sure that I'm going to take advantage of that up point 12 months from now. The monthly average, we see people deviate there, our direct funds there, I should say, when we have more of a volatile market, because that's going to do just what it says. Each month, that interest is going to credit. So we're going to look from month to month instead of from year to year. So it'll average out those returns. So in those volatile markets where we might be up, we might be down really low, it's a nice place for your funds to be in that monthly average. And then we refer to the segments. Our segments, they mature on the 15th of the month, so we can set up an annual. Again, you can go from January 15th of 23 to January 15th of 24. That would be an annual segment. And then we also have multi-year. I don't see these used quite as frequently because what happens is you really can't take a look at the returns until you get into that multi-year. So if you did a 2-year, let's say, on that first year annual statement, you're not really going to see anything because we don't have that point, right? We have to go 2 years till we get that point. So multi-year, I don't see used quite as frequently. It is an option for you though. So there's a lot going on. It's really universal life, index universal life, again, is the same as universal life, just plus the indexed choices for your client. That's really the difference. If we look at the meat and potatoes of it, it's still the same universal life policy that we have. We have permanent death benefit protection. So we can design these products, and we'll talk a little bit about different options. We can design them to be fully guaranteed. If you have someone that says, I really like guarantees, but I still want maybe a little bit of upside with that cash value. So we can do that, we can have that. So permanent death benefit, the death benefit, of course, income tax free, doesn't matter if it's IUL, UL, whole life, you still have that option. It's going to be a tax-free death benefit paid out to your client's beneficiaries. And then we talk about the tax deferred growth of these types of contracts. It's a great place for those folks who have maxed out their 401ks, who have maxed out their Roth, or maybe their income is too high, they can't participate in a Roth. They still have that tax deferred cash value growth. So anything inside of this contract is growing tax deferred. So really, really great option for those high income earners that have maxed out, or think about your business owners who want to reward and retain a key employee. In this great resignation we have going on, a lot of the businesses are saying, gosh, I really need to keep, Sally and Johnny and Joe. How do I do that? We set up a cash value life insurance option for them. And then income tax-free access to cash goes with the deferred cash value growth. We want to be able to access that cash and not pay tax on it. So if we set it up right, and Alex and the team over at ArtJetter can definitely help you design it to make sure we do it right, then the cash comes out, or any kind of income comes out tax-free. So we talk about the potential for growth. Again, that's why the index universal life contract was brought to the marketplace. I didn't want all that volatility that I found in the variable space many years ago, but I also don't like zero as a cash value in a full no lapse guarantee contract. So we want that potential for a little bit of growth, whether I want a guaranteed death benefit or I really want to maximize my cash value. We're looking for growth. And I also don't want that loss of principal. So I mentioned that zero floor. That protects me. You guys might have heard out in the marketplace, zero is your hero. We hear that quite a bit with Index Universal Life. I have a zero floor. I will be unaffected by the marketplace if it tanks majorly, or if it just goes down 4 or 5 points. I will always get zero. I will never get a negative return. Now, I do like to add here that we do, obviously, it is still life insurance. The client has to have a need for life insurance, because obviously we have cost of insurance and admin fees and charges inside an IUL. So it's not there are still charges, right? It's a universal life contract. But from a pure market standpoint, when that index is up 9%, I've got a 9.5 cap. I'm gonna take that 9% gain. When it goes down 9%, I'm gonna be unaffected. So I think it's important here to see, who do we look for in our book of business that might benefit from this? We'll talk about a couple platforms that we have at Nationwide, and you probably have with some of your other carriers with Jetter, to help you bring those clients in the door. But again, we really want these clients who are, I would say, risk averse. I mean, they understand the market. They just don't want to go there with their life insurance, but they don't want to have that zero cash value. So they want a little bit of upside. They're okay with some of that risk, right? If the index goes up to 12 and they're capped at 9, they understand that. They don't want all of that negative 32% maybe, but they're okay with giving up, an extra 10 or maybe 10 points if the market does something really good. So they really want to be kind of in the middle. Some of those clients I mentioned will still be looking for guaranteed protection, and that's completely fine. There are IUL contracts, Nationwide has one, other carriers have them, that have a full guarantee still on an indexed universal life chassis. So a lot of folks always thought, well, if it's indexed, I can't have guarantees. That's just not true. There's a lot of options out there in the IUL space. And then, of course, your clients, as I mentioned earlier, a couple examples, those are business owners that want to reward and retain. They're looking for some cash value growth. those clients that have, again, maxed out their 401ks and their Roth IRAs. They're looking for another place to put some money that's not subject to regulation. So I don't have to worry about, well, if I put my 26,000 into my 401k and I put my 6,000 into my Roth, can I only put 5,000 in the cash value life insurance? No, there's no limit. So great, again, for your high income earners. So just a quick visual here on where this falls. When I mentioned it's the middle of the road for your sort of risk adverse. When we think about pure protection and 100% guarantees, obviously whole life all the way to the left. That's going to be the most sound, the most, all your guarantees there. I've got guaranteed cash, I have guaranteed death benefit. The only non-guaranteed in that is, of course, the dividends. Those fluctuate year to year, we know that. But from a pure guarantee, and then we go to the no lapse guarantee UL. Again, we've talked through that. I'm going to have a guaranteed death benefit, usually no cash value in those types of contracts. And you'll see indexed accumulation a little bit in the middle here, or actually a little bit further to the right. So I'm comfortable to a point with some risk. I don't want to go all the way to that variable side, right? I want to be in the middle. So again, this is the clients we're looking for that are comfortable with a little bit of risk, don't want to take it all, and understand that they are protected with that zero floor. So I just want to look real quick and give you some ideas on what we have here at Nationwide. And again, I know Art Jetter has a lot of good sound companies that you guys can work with that have similar type policies. But from a nationwide standpoint, we have 3 IUL products. Our first one is the IUL Protector, and that's exactly what it sounds like. It's a protector. I can dial that guarantee all the way to 120. So again, I have the full guarantee with some upside potential depending on which index accounts I look like and the performance. Then I will go to that IUL accumulator. That is going to have a different guarantee based on the age of the client. So let's say it's a 20-year guarantee, and we'll have a 20-year guarantee, but we're going to solve for a minimum death benefit usually in these scenarios to maximize a cash value buildup. So those clients there have that option. We still always will have some innate guarantee. It just won't be all the way to 120. I can't have massive accumulation and full guarantees because there's obviously a charge for the no lapse guarantee riders. The last contract that I'll talk about, and we did a little bit for those that were here last week, is our Second to Die. So it's a Second to Die Survivorship Index Universal Life. And what this product is it's just like it sounds. I have 2 insureds. So I have a husband and wife in our example, let's say that. I can also have business owners. I can have a mother and a daughter. I can really, as long as there's an assurable interest, I can put whatever 2 people I want to on this contract. What this policy does is similar to the IUL Protector. I can dial that guarantee to 120. Most often in a Second to Die, we're looking at wealth transfer, so we really wanted to leave those guaranteed options there. I don't have to select them though. I can select a much lower protection guarantee age if I want to. But we'll put a husband and wife, let's say we did $1 million policy and they both die, nothing happens. Both of them pass away. Obviously, $1 million is going to go to their heirs or their charity, and all is well. They will still have some accumulation. I have seen some people use a Second to Die as an accumulation vehicle because the cost of insurance rates are just a little bit lower when you look at the life expectancy of 2 versus 1. So don't shy away from an accumulation sale where you might take a look at using a Second to Die contract for that reason as well. Now, next, I'd like to talk about some of the riders. And again, Nationwide has these riders listed. I know other carriers do as well. But especially when it relates to our protection and our Second to Die, we see a lot of our applications coming in with our long-term care rider. So this can be added on if they are a table E or better. So we go pretty high on the rating for the long-term care rider. It's a cash indemnity long-term care rider. What does that mean to you? That means once the client has a document saying, I am 2 of 6 dependent on my daily activities of daily living, so I need help maybe transferring and feeding myself, I can go on claim. Once I'm on claim, Nationwide's going to send that check monthly to your client or the policy owner, and there are no receipts. There is never anything else you need to show us. Usually every 12 months, we'll do what we call a recertification, but we can have that cash value, cash indemnity long-term care rider. And again, I usually see that on the protection and the Second to Die. You can put it on a cash, but if you're building cash to take out income stream down the line, and then you have to tap it for long-term care, it can sort of muddy that type of design up. So I like to see those two separate. There is, some school that people like to put them all together, and that's completely a personal choice. For those who cannot qualify for our long-term care rider, we will add a chronic illness rider onto those policies that are Table D or better. So that again is that there's no charge for that up front, but there is a charge at time of usage. So don't forget that point, because it can be significant at time of claim. They won't normally get 100% of the death benefit. But I like to bring these riders up when we talk about IUL, especially again, the protection and the second to die, because we see them utilized a lot. And I just want to make sure that you're aware they're there when you have those types of conversations. And I'm going to hit a couple platforms, Alex, on underwriting and how we can, maybe think of some clients to hit here. Is there any questions you want me to answer before I go to one more slide?
No,
all right, I'll
be fine. We can.
Okay.
Questions at the end.
Awesome. All right. I will roll on to the next one then. All right, so we talk about IUL, and I'm sure now you're all thinking, I have these clients that I think would fit for this type of a product. Now what do I do? So I wanted to bring these to the table for you because this really helps make that sale a little bit easier. And at Nationwide, and again, other companies that our jetter can offer to you, they have what we call accelerated underwriting. What does that mean? Accelerated underwriting is great. It actually has been fast-tracked due to COVID, and I hate to use that dirty word, sorry, but it has been fast-tracked. Accelerated underwriting gives us the opportunity to take your client from application to issue without exams or labs. So at Nationwide, our acceleration ages are 18 to 50, up to 5 million. And we're looking for your standard and better risks. Okay, so if you have your, diabetic who's also overweight, who has heart disease, they're not going to get through without labs likely, right? I'm going to need to see what that A1C was and see what, the cholesterol looks like on that client. So not everyone is going to pass through there, but 18 to 50 standard all the way up to preferred plus. We can use this program. We can even use it when we add a long-term care rider. So we can do all of this underwriting without potentially bothering your client for labs and exams. So it's a really cool way to look at things. And then the next one down, Executive Advantage, very similar. What that just says is if I have an executive, so you have that business owner I mentioned earlier, and he or she is going to get a policy, their boss is going to put, employer I should say, is going to put a policy in force for them to try to retain and reward them. If they had an executive physical in the last 12 months, and they're making, we say 150, we're a little bit lenient on that. So if you have someone that's 125 or 142, we'll entertain that, of course. But we want to say they've had an executive physical, including labs, in the last 12 months. We will also use that in lieu of going out and having a paramed go disturb your client. So again, trying to make it easy for folks to get in the door and get applications in and take that through the underwriting process as painless as possible for your client. This last one, I will tell you, has been really successful, and we've had this on the dockets for years. So this wasn't a COVID invention. This is something that we've actually had for over 10 years, but it's really just become more prevalent, not so much because people don't want to have exams. We understand that in labs. Nobody wants to be disturbed. We couldn't do that during COVID, right? But now I think it's just people are busy and they just don't really want to be bothered. So this term plus perm platform says to your client, if they were issued a term policy in the last 36 months, standard or better, and they're still in the same health. So again, I don't want someone who's, I was just diagnosed with cancer, I'm going to survive 10 years, I need a permanent policy because my term's expiring. That's not who we're looking for. It's not guaranteed issue. But if they have that term policy, what we've seen a lot in the sales that we've had in the door in the last few years on this is pre-COVID or even during COVID, business owners and clients were buying term insurance because they knew they needed coverage. They also knew they needed permanent coverage, but they just didn't pull the trigger with all the turmoil going on in the world. Fast forward, I know we're still in a little bit of turmoil, maybe a looming recession. Some people will say we're in a recession. So there's a little turmoil here yet as well. I understand that. But people will take their term policy, and we will at Nationwide issue a permanent policy based on the underwriting they had under that term platform. So standard or better, 36 months or sooner. And so the example is you have John who bought a $5 million term policy with ABC Company. He really needs $1 million of permanent coverage for his family to go beyond that term duration. We take a copy of that spec sheet of his term policy. We're going to do the Nationwide application. We'll do a Part B, so we are going to have the agent fill out that Part B. You're going to fill that Part B out, and then that goes to Nationwide. And we'll do our behind the scenes. Of course, we're going to pull that medical information bureau. We're going to pull that prescription check, make sure everything's cool. And then we're going to send that policy to issue. So I have 2 examples of cases we just did this past, actually January, now that we're in February, in January, where that happened. And it was within 4 days of the application coming in and then getting set up, where we actually issued that policy. So I encourage you to think about who did you write term on in the last 36 months that might benefit from an IUL type sale, and then jot them down, give Alex a call and let him put together a couple of scenarios for you so we can move those to permanent coverage for you. Maybe it's adding a long-term care rider, maybe not, but definitely utilize these platforms to help make your opportunities and your sales just slightly easier, because we know underwriting is tough for folks, and nobody likes to be prodded or stuck and have labs done, but we're here to help and try to make that easier. So I'll just do, just a quick summary again. Indexed Universal Life, same chassis as Universal Life, but it allows your client to pick different index funds. There's various different funds throughout the numerous carriers that you have at your disposal. They're going to pick the index fund. They're going to look at the cap rate and the participation rate and keep an eye on those policies. Everything else is the same. Again, the tax-free death benefit, tax-free growth, and the accelerated platforms that you have here to make that a little bit easier to get those sales running for you as we go into 23 or continue to go through 2023. We're here to help you at Nationwide. Our Jetter team is phenomenal in designing those for you. So I'll turn it back to you, Alex, to see if there's any questions.
Perfect. Yeah, thanks, Charlene. There's a lot of great information. As a reminder, you can type questions into the question box on the bottom on the right-hand side of your screen. We do have a few questions here. One of the first ones was on that long-term care rider. What percentage of that could be used on the policy?
So on the individual policies, we do 2, 3, or 4% of the death benefit. And on the second to die, we have just the 2% option.
Sure. And then how much of that death benefit can they use up? Is it the full 100%?
100%. So on the long-term care rider, it is 100%. So if it's $1 million policy on just one life, the entire $1 million will be paid out. And then there's also a residual death benefit. On the second to die, it works a little differently because we have 2 people, right? So if they both have long-term care, that same $1 million policy, each insured gets $500,000. So they literally split that life insurance death benefit in half. So let's just say I have Mr. and Mrs. at $1 million. Mr. passes away, never having a long-term care claim. Mrs. uses up her $500,000. Then that remaining $500,000 would go to the heirs.
Perfect. This is a good question. How do we avoid a modified endowment contract?
Yeah, that's a great question. We definitely want to do that, especially if we're solving for that accumulation that we mentioned. Not as big of a deal if we're just looking at a pure estate transfer and I want to guarantee the death benefit to 120. But we do the solve design. So we always will solve. I'll use the accumulation story. Let's assume we're accumulation. We want to put in, I'll pick a number, $50,000 a year for 10 years. We will solve in the illustration for a minimum non-MEC death benefit. So we actually specify in the design that I do not want this policy to be a MEC. So not only do I solve minimum non-MEC, there's actually a box inside the illustration software to say avoid MEC. So we have 2 safety points to make sure that doesn't happen. It's a great question.
Yep, yeah, definitely. And then do they have to pay taxes on gains? So on that accumulation value?
They do not. So that again goes to the design. We want to make sure we design it properly, but typically in an IUL accumulation story, when I go to start taking withdrawals, I usually take those in the form of loans. Sometimes we can design withdraw to basis, which is withdraw to what I put into the contract. Oftentimes the loans will look a little bit better. As long as I structure that properly, and the key is not to let the policy lapse, and you just don't want to let that lapse. If you lapse the policy before death, then yes, there could be what we call phantom income, and that would be taxable. So it's really key on an income accumulation contract to make sure that stays in force. And you'll see that on your illustrations, and then obviously year over year when you do your policy review, you'll keep an eye on that.
Perfect.
I guess I could also add too, there's lapse protection riders that we have built into our contract and other carriers do to avoid that type of situation.
Mm-hmm. Perfect. Yeah, I think that's all the questions we have at the moment. If you do have any additional questions before we wrap it up, feel free to put it in the question box. Otherwise, you can give us a call or send us an email at life@jetter.com. There's lots of great resources Nationwide has. I know you guys got great long-term care reference guide and an IUL reference guide. You get familiar with the terms and how the whole product itself works. So I don't know if you have anything else to add, Charlene.
Yeah, that's great. Actually, we have a new brochure that we just got together on the IUL, so I'll send that to you as well, Alex, and you can send that out to the group for their interest. And definitely, I can add the LTC reference guide too if you want to have that, so you have it all in one spot.
Yeah, for sure.
Good.
Well, yeah, I think that should be everything then. Yes, you all will get a copy of this webinar here in the next hour for tapping in. Yeah, if you have any other additional questions or need an illustration, like I said, give us a call or send us an email. Again, thanks everyone for joining us today, and thanks Charlene for all the great information.
Yeah, thanks for having us, Alex, and thanks again for joining us. We appreciate it.
All right. Well, everyone have a great day.